Assalamualaikum and salam sejahtera. Hi everyone. So this video is prepared for topic 4, Principles of Double Entry and Tri-Balance. The coverage for this topic are double entry rules, ledger entries, balancing of ledger accounts, tri-balance, and final accounts for pre-adjusted only. At the end of this topic, you should be able to apply double entry rules to prepare ledger accounts and to balance off the account, and then to prepare unadjusted tri-balance and also the financial statements. Alright, so let's look at the first one, double entry rules. What does it mean here by double entry rules? It means that for every business transaction, it must have at least dual effect on the accounting equation. It could affect more than one item in the accounting equation, but at least, alright, it must have dual effect or two effect on the accounting equation. Alright, for example, so this is the example that we have discussed in the previous topic. Okay, the same example that we are going to use here. Number one, started business with the type 35,000 cash. So who started the business? The owner started the business, meaning that the owner brought in cash into the business of 35,000 ringgit. All right, so what is the effect to the business? What is the effect to the business? Accounting equation. So let's focus on the business, right? Because we are recording for the business. Okay, so what happened here? The business received from the owner cash of 35,000 ringgit, and cash is to be recorded as an asset of the business. Okay, what about the um and then we have to record also, okay, the source of the money. Okay, the source of the money. So the money comes from the owner. All right, so the money comes from the owner and it will be recorded as capital. All right, so here what happened to the owner's equity? Okay, the owner's equity will be increased. Cash increase, asset increase, capital increase, owner equity increase. So what is the effect? Asset increase, equity increase. All right, and then in terms of the recording, so we have to record in the journal entry. Okay, so the first entry is the journal entry. So we need to identify which account to be debited and which account to be credited from this transaction. All right, so we have identified the effects. Okay, is the effect of this transaction. Okay, the effects. Okay, is increase, okay, the asset and also increase the equity. So what happened when there is an increase in asset? Okay, when there is an increase in asset, we have to debit asset account. All right, we have to debit asset account. And then what about the equity? Okay, increase in equity, it will be credited. All right, okay. Okay, before we proceed with the discussion of the ledger entries, all right, so let's recall what we have learned previously. Okay, so from the discussion just now, okay, we talk about the increase in asset and also the increase in equity, okay, due to business transaction of started the business with 35,000 cash. Okay, so what happened? All right, there will be an increase in asset of the business and also increase in the business owner's equity. Okay, all right. So what about the journal entry? Okay, what about the journal entry? Okay, what about the journal entry? So I think we have discussed previously also in the previous topic. All right. So what happened to the journal entry when there is an increase in asset? So we are going to debit asset account. So we are going to debit asset account. All right. So debit asset, but which types of asset? You have to be very specific. So cash. How much? 35,000 ringgit. All right. And then what about increase in equity? We credit equity account. So we are going to credit equity account. But the question is, which equity account? Is it a drawing? Is it a capital? So capital. Okay, same amount of 35,000 ringgit. Alright, okay, so from this journal entry, now we are going to post to the ledger. This is the net process in accounting cycle. So we're going to post to the ledger. Okay, so what happened to this business transaction? For each business transaction, it will have to be recorded on debit side on one ledger account and credit side on another ledger account, meaning that for a business transaction, okay, for one business transaction, okay, we need to open or prepare or post two, all right, at least two different accounts, at least two different accounts, all right. So in this case, okay, okay, where the owner started the business with 35,000 cash, so what happened? Okay, you debit cash, you credit capital, meaning that there will be two different accounts. So the first account is cash, the other one is capital. Okay, what is the format of account? All right, so basically we call this as T account. Okay, and on top of that T account, we have the account title. All right, and then on your left hand side is the debit side, your right hand side is the credit side. All right, and then you are going to include the amount and also the particulars, and if you have the date, then you have to include also the date. All right. Okay, so let's try to prepare ledger entry for this transaction. So we are going to post from the journal entry to the ledger entry. All right, so it's going to so you have to open two different accounts. All right, so we're going to prepare an account, two accounts. Okay, one is for cash, another one is for capital. All right, so how to read this journal entry and then to transfer to ledger entry? Okay, so please listen carefully. So cash here represent the account title or name of account. All right, so cash. Okay, debit here meaning you are going to record on the debit side. So which one is the debit side? Your left hand side. All right, your left hand side. How much? This amount 35,000 ringgit. Okay, so this is the very basic preparation of account. Okay, but then if you simply state the amount, all right, without any details or particulars of the transaction, then you might not know this money comes from whom. Okay, so you have to state, okay, comes from which account. All right, from account capital, from account capital. So you just refer to the next entry. Okay, that one come from capital, so put it here as capital. Okay, all right, so now let's look at the next one, credit capital. So meaning account capital. Okay, on which side? Credit. How much? 35,000. So this is the contribution from the owner, 35,000 ringgit. In what form? Cash. Okay, you just refer to this one. Alright, when you record, okay, for capital account. Right? Okay. Alright, so next. Alright, so we have here, okay, what we have discussed before. Alright, except that I put it here very nicely. Okay, so the transaction on 1st January started business with 35,000 cash. So who started the business? The owner. Alright, so meaning the effect is, okay, so we are recording, remember, we are recording on behalf of the business, okay, on behalf of the business. So what happened to the business? So now the business received cash from the owner of 35,000 ringgit, all right, and cash is to be recorded as asset. So what happened to the asset of this business? Increase. All right, at the same time, business has to record the contribution from the owner. So how much is the contribution from the owner? 35,000 ringgit to be recorded as capital. Okay, to be recorded as capital, which will increase the owner's equity. Okay, which will increase the owner's equity of the business. Okay, so increase in asset, we debit asset account. Which asset account? Cash. How much? 35,000 ringgit. Okay, increase in equity, we credit equity. Which equity account? Capital. Okay, how much? 35,000 ringgit. All right. Okay. Meaning that there will be two different accounts. The first one is cash, the other one is capital. Okay, so cash will be that 35,000 cash will be recorded on the debit side of cash account. But the particulars we are showing, this cash comes from which account? From capital. Okay, and then in capital account, we are going to record on the credit side, okay, 35,000 ringgit. All right, the particulars is cash because you need to state, okay, the contribution, the types of the contribution, okay, from the owner. It could be cash, it could be motor vehicle, it could be building, land, and other types of asset. All right, okay, next. All right. So we have discussed previously, there are different items in accounting equation. Okay, asset, liabilities, and equity. All right, and then equity we expand. All right, and then we have revenue, expense. Okay, capital and drawing. Okay, all right. Okay, so this is the basic. Okay, when we prepare account. Okay, so for asset account. Okay, on the debit side, we record an increase in asset. Okay, we record an increase in asset, while the credit side, we record the decrease in asset. So this is in line with our discussion before this, okay, regarding the increase or decrease in asset, and then which account to be debited and which account to be credited. All right, okay. What about the liabilities? Okay, for the liabilities, increase you credit, decrease you debit. Okay, similarly for capital account, okay, increase you credit, decrease you debit. Okay, for the drawings, because drawings sit on the same side as asset, so it will be similar to asset. Okay, increase in drawing will be debited, decrease in drawing will be credited. Next. Okay, a revenue account, okay, sit together with the equity and liability. Therefore, any increase in revenue will be credited. Okay, decrease in revenue will be debited. For the expense account, okay, this one is similar to asset account. All right, so any increase in asset account, any increase in expense account will be debited. All right, while decrease in expense account will be credited. Next. All right. So at the end of the day, all right, at the end of the day, at the end of the week, all right, or whenever we need to close our account, all right, we are going to balance off, okay, the ledger accounts, okay, we are going to balance off, all right. So throughout the month, for example, here, okay, throughout the month, okay, you have recorded all the transaction that happened. Okay, this is a very simple transaction. So we have bank. Okay, we receive capital, okay, from the owner of 35,000 ringgit. All right, and then we deposit the money to the bank, 30,000 ringgit, because it is quite impossible to hold 35,000 cash in hand. All right, so we deposit to the bank 30,000 ringgit. That's why we credit cash, and then we are going to debit in bank account. All right, and then the business make purchase of goods, okay, 1,500. Okay, paid for office expenses, 500. All right, so that's it. And then at the end of the day, okay, we are going to balance off account. All right, so there are three steps here, okay, to balance off account. So step number one, okay, step number one, first we need to calculate the total for both side of account. You just calculate the total, okay, you don't have to write it down first. Calculate the total, okay, and then to pick the higher total, okay, between debit and credit, you will find a lower total and a higher total. So you pick the higher total, okay, and that will become the total for both sides. Okay, so in this case, 35,000 is the higher total compared between debit and credit compared to credit, right? Okay, so we're going to put 35,000 on both sides. All right, and then we're going to number two, any difference between the total, okay, step number two, any difference between the total is known as balancing figure and recorded as balance CD in the side with the lower total. Okay, so on the credit side, okay, if you calculate the total, all right, if you calculate the total here, okay, so the total is 32,000. 32,000. 35,000. Okay, compared to debit side, we have 35,000 ringgit. Alright, so we calculate and then we pick the higher. So the higher total is 35,000 ringgit. Alright, the balance, the difference, okay, will become the balance CD. CD means carried down. Okay, carried down. Okay, because we are going to carry this down to the following month. Alright, okay, so the difference is 3,000. So 3,000 will become the balance CD. Okay, step number 3. Okay, so after you close the account, then you're going to bring to the next month. Okay, so this is a common way. Alright, so we're going to transfer to the next month. Alright, so balance brought down. Okay, brought down from last month to this month. Alright, brought down. Alright, so transfer the balance CD to the opposite side. Right, to the opposite side and recorded as balance BD. Okay, why? Because cash account is asset account, all right, and cash account usually, okay, will have a debit balance. This is what we call as debit balance. All right, okay. Next. Okay, so basically for balance CD, there are different types of balance. Okay, we have debit balance, credit balance, and zero balance. All right, so debit balance are for asset, expense, and drawing. Okay, meaning that in your account, okay, for asset, expense, and drawing, okay, you will have balance CD on the credit side. This is credit side, this is debit side. But this is what we call as debit balance. Even though it is located, on the credit side, but balance CD on credit side is called a debit balance. Why a debit balance? Because you are going to carry down this balance to the opposite side, which is to the debit side. Okay, all right, so this is why it is a debit balance, right? It is a debit balance. Even if we transfer this balance CD to the try balance, okay, it will be disclosed, okay, on the debit side, right? Because this is a debit balance. Okay, what about the credit balance? Credit balance meaning, okay, credit balance meaning balance CD would be on the debit side. Okay, balance CD is the amount of balance that you calculate at the end of the month. Okay, so this is the balance. This is what we have at the end of the month, all right, or at the end of the year, or at the end of the day, depending on the volume of the transactions, right? So for capital, liability, and revenue, okay, you will have credit balance. Why credit balance? Because you are going to carry it down to the credit side. Okay, balance BD. It will become a balance BD. Right? So this is credit balance. Alright. Okay. We may have zero balance, meaning that when you calculate the total between debit and credit, you get the same amount. So there is no balance CD and there is no balance BD. Alright? Okay.